The EU has banned seaborne oil imports from Russia, beginning on December 5, 2022. It also joins the United States, the United Kingdom, and the rest of the Western world in forbidding its companies from delivering Russian oil anywhere in the globe or providing services like insurance, unless Moscow sells its oil below a price cap of their choice. Nonetheless, some experts believe the EU ban and price restriction will reduce global oil supplies and ultimately push up gasoline prices. In this video, we will look at what this oil cap means to the already struggling global economy. Stay till the end of the video to find out. The EU, G7, and Australia have agreed on a price cap on Russian oil in order to limit Russia's earnings while ensuring Moscow continues to supply the global market. Russia is the world's second largest oil exporter, and without the restriction, finding new consumers at market pricing would be simple. Only oil sold at or below $60 per barrel can be delivered under the terms of the legislation. The restriction went into force with an EU ban on Russian crude oil maritime supplies, which comes many months after an embargo imposed by the US and Canada. Companies based in the EU, the G7, and Australia will be prohibited from providing services enabling maritime shipping, such as insurance, with oil priced over that level. The G7 countries, Canada, France, Germany, Italy, Japan, the United Kingdom, and the United States insure 90% of the world's cargo, and the EU is a big participant in maritime freight. This implies they should be able to pass on the price cap to the vast majority of Russia's clients worldwide, resulting in a genuine pricing cap. There will be a transition period during which the restriction will not apply to cargoes loaded before December 5th, and a new cap on oil products will go into force on February 5th. The embargo, service bans, and price cap all add up to an unparalleled political reshuffling of global oil flows. However, the sanctions' impact will be determined by Russia, the West, and those emerging nations attempting to maintain neutral in the face of Vladimir Putin's invasion of Ukraine. Meantime, Russia has rejected the price cap, with Kremlin spokesman Dmitry Peskov saying that Russia has to evaluate the situation before deciding on a precise reaction. Russia's permanent ambassador to international organizations in Vienna, Mikhail Yulanov, tweeted that the government will suspend oil supply to countries who support the cap. He described Western moves as politically motivated anti-market decisions, putting at risk the stability of the oil market. The West has set a cap of $60, which is far more than the present cost of producing oil in Russia, so Moscow will have the incentive to continue pumping crude. Even if outcome is cut, Russia will continue to generate money. Russia must retain an interest in selling its oil, or risk reducing global supply and causing prices to soar, said one European official, who did not believe the Kremlin's threats to stop deliveries to countries complying with the cap. According to the official, Russia would be worried about preserving the state of its infrastructure, which will be harmed if production is suspended, as well as retaining the trust of its consumers, notably China and India. There is going to be a shortening of supply, and therefore a price increase for crude oil, and that will get reflected in an increased price at the gas pump for all of us, said Krishna Maruti of the University of Houston. According to Krishna Maruti, the Western efforts would result in a 5% to 10% spike in U.S. gasoline prices during the next 3 weeks. Other headwinds for global oil prices include an OPEC Plus decision to maintain output at present levels, which may further restrict supply, as well as the likely easing of COVID lockdowns in China, which might boost demand. We will sell oil and oil products to countries that will work with us on market terms, Russia's Deputy Prime Minister Alexander Novak said during an OPEC Plus video conference on Sunday. We are currently working on mechanisms to prohibit the use of the price cap tool at any level, Novak continued, warning that the cap will only create further market destabilization. Taken together, these variables might cause gasoline prices in the United States to rise by up to 25% in the next 3 weeks, according to Krishna Maruti. Meanwhile, oil prices rose early Monday, reversing last week's dip to their lowest level since early January, as markets awaited Russia's reaction to the price cap on its crude supplies. Brent crude increased 2.4% to $87.64, while West Texas Intermediate rose 2.6% to $82.06 in the United States. However, the U.S. markets mostly ignored the oil rally on Monday, as investors shifted their expectations for the length of the Federal Reserve's aggressive monetary policy campaign. The Dow Jones Industrial Average fell 0.8% or 260 points as the bond market plunged, with the 10-year U.S. Treasury note rate climbing 6 basis points to 3.56%. Furthermore, China, the world's second-largest oil user, has put major upward pressure on prices as recent reopening hints show increased demand for fuel in the nation. Several banks are already predicting that oil prices, which reached near-record highs early this year, will rise higher next year. Goldman Sachs strategists estimated last week that Brent crude prices will average $110 per barrel in 2023, a 26% increase from Monday, while Bank of America expected a more modest $100 2023 average for Brent, with a jump to $110 in the second half of the year as Asian travel rebounds. Recession-related demand issues, with Goldman saying only an economic hard landing in the United States would justify sustained lower prices for the commodity, and the Kremlin's next move, with Bank of America noting further disruptions of Russian supplies present clear upside risk to oil prices, are key storylines to watch for oil price movements. The EU, on the other hand, argues that the cap would assist in stabilizing markets and directly benefit emerging economies and developing countries, which will be able to get Russian oil at a cheaper cost. The market price of Russian Urals oil is now hovering around $65 a barrel, implying that the move will have only a modest impact in the short term. Ukraine recommended that the threshold be set even lower, saying that the $60 level is insufficient to punish the Kremlin. The fact that it took nearly 6 months for the EU and the US to reach an agreement on the cap indicates the proposal's complexity and the eternal squabbling with the factions to get at a figure. There are two issues here. As a response, the price cap aims to balance two opposing goals: how to reduce Russia's oil and gas revenues while also limiting world oil supplies, which may exacerbate runaway inflation further. That is the source of the problem. When the EU originally suggested the ban in May, the implication was that it would be devastating to Russia's oil cash flows. The fact that European shipping lines and insurers have long maintained a stronghold on global energy markets added to their influence. However, although a ban is designated to put pressure on Russia, it cannot be allowed to become a chokehold on Russian crude. If Russian oil does not enter the global oil market, crude prices may possibly skyrocket, affecting consumers in the EU and the US as well as the rest of the globe. The threat of a surge in inflation is extremely serious. As a result, the floor price formula was chosen. Each EU and G7 member state will be required to oversee companies headquartered in their jurisdiction. If a ship bearing a third country flag is found carrying Russian oil at a price higher than the cap, Western operators will be prohibited from insuring and financing it for 90 days. While Russia may be tempted to establish its own fleet of tankers, operating and insuring them, the EU believes that building a maritime ecosystem overnight will be very complicated, and such unplanned solutions may have difficulty persuading consumers. However, the EU risks retaliation if Russia cuts off all petroleum shipments to the continent. While the EU no longer imports Russian oil by ship, the continent still buys Russian oil through the pipeline. Meanwhile, analysts believe that the other countries presently receiving Russian oil by ship, China, India, and Turkey, will be able to avoid the cap. Last week, India said it would continue buying Russian oil without using Western finance or insurance. Treasury Secretary Janet Yellen has already stated that India would be happy to do so, even if the price of oil is higher than the cap. According to media reports, Russia is developing its own fleet of tankers in order to avoid Western pricing controls. Oil might also be transported from one ship to another and mixed with oil of comparable quality to hide its source.